You see now that Senator Chris Dodd of Connecticut, chairman of the Senate Banking Committee, he is speaking right now to Fed Chairman Ben Bernanke. He's in his second day of testimony in the Humphrey Hawkins semi-annual monetary policy testimony. We're going to take you there live for this question and answer session being kicked off right now by Senator Chris Dodd of Connecticut.
What are the problems out there? The commercial real estate issue is one that I know is, some have suggested, may even dwarf the residential mortgage problems in the country. The consumer borrowing practices, the overdraft issues and so forth that still persist. Consumer debt issues obviously are looming as well. What are those problems you see coming along, and what steps? For instance, are you considering extending the TALF program on the commercial real estate area, for instance, beyond the expiration, I think it's in December, if I'm not mistaken, and whether or not that program will be extended to accommodate the problems in commercial real estate? But what recommendations would you give to us to start to deal with that other side of the equation, the stability of institutions, but now, and you mentioned some in your statements, but I'd like you to elaborate, if you would.
Certainly, Mr. Chairman. On unemployment, that is the most pressing issue, and it's the most difficult aspect of the problems that we're facing. Both the Federal Reserve and the Congress have already taken very aggressive actions to try to stimulate economic activity, and I'm hopeful that we're seeing some stabilization in the economy. Beyond that, I think to address unemployment more directly, the Congress has already extended UI, unemployment insurance, to help those who are without work. One particular problem which is concerning is that people without work for an extended period may lose their skills. They may find themselves with atrophying skills and inability to find work once the economy has recovered. And so I would call to your attention the possibility of expanding training and other programs that would help people maintain those skills or develop new skills as needed to enter new industries. But again, I believe this is one of the most difficult and challenging parts of our task at this point. On commercial real estate, we agree with you that this is one of the more difficult areas. During the last few years, while residential investment was declining sharply, commercial real estate was actually pretty strong. But we have seen now in the last 6 months or so that vacancy rates are rising, rents are falling, prices are falling, and financing conditions for commercial real estate have gotten a good bit more difficult. We are working to try to improve those conditions. We're working with banks, for example, in the same way that banks should be encouraged to try to work out defaulting mortgages for residential borrowers. It's in their interest to try to make arrangements to work out problem loans in the CRE area as well. And many banks will be facing very extensive amounts of CRE challenges going forward. On the TALF, as you know, we have recently added to the list of assets that we are supporting both new and legacy commercial mortgage-backed securities in an attempt to open up the CMBS market, which has been an important source of financing for this area in the past. It's early yet to know how much effect that will have, but we're encouraged by the effects of the TALF on some other areas, such as consumer lending and small business lending. We currently have an expiration date of December 31st on the TALF, as you pointed out. We will certainly be monitoring the situation, and if markets continue to need support, we will be extending the final date of that program.
And you have the authority to do that. You don't need any action by Congress to do that.
We don't need action, but we are using the 13(3) authority, which requires us to make a finding of unusual and exigent circumstances. So we would have to continue to believe that financial markets were in essentially still some distance from normal operation. If they're in normal operation, then it would be more difficult for us to justify such action.
Well, I appreciate the answer on that. Let me go back, and I appreciate the steps that you've taken on dealing with credit cards and dealing with the residential mortgage market and steps. And so don't misunderstand what I'm saying in terms of what you've responded to. Obviously, a crisis was emerging here. But there is a history at the Fed which is deeply troubling to me when it comes to consumer protection. You go back, if you will, in 1975 with the FTC Act, which gave the authority to the Fed to deal with protecting consumers for unfair and deceptive practices. Even as late as 2001, when the FDIC and the OCC wrote to the Fed urging that there were problems out there that needed to step up, the Fed didn't respond to it. We've all talked about, I listened to Jim Bunning even last week, we talked about the 1994 Act, the HOPA legislation. And that we went 14 years before the Fed, under your leadership, stepped up and responded to that situation with a series of regulations dealing with the residential mortgage market. There seems to be a pattern of behavior by the Fed over the years that would lead us up here to be concerned about whether or not this is just a momentary response to a crisis that's in front of us, to step up, rather than the kind of consistent behavior that we would depend upon of the Federal Reserve to act when it comes to consumer issues that have been hammered by the problems in the residential mortgage market as well as in some of these consumer products. Give me a reason why you think this is something I should be less concerned about given this pattern of behavior.
Mr. Chairman, I understand your concern entirely. It's not literally true the Federal Reserve was inactive. We did take steps. We did invoke HOPA authority to broaden the scope of high-cost loans, for example, but we were not quick enough and we were not aggressive enough to address consumer issues earlier in this decade. I agree with that. So I think what we have demonstrated in the last few years is that we have the capacity, we have the ability, we have the expertise, the range of abilities, and the complementarity with our other activities to be effective when we are working in that direction. So my recommendation to you to consider, Mr. Chairman, would be to ask whether there are steps that could be taken that would strengthen the commitment of the Federal Reserve so that it would be strongly committed to this area in the future. And a few suggestions I would make. One would be to put consumer protection in the Federal Reserve Act along with full employment and price stability as a major goal of the Fed. A second step could be to require the chairman to come before you or another committee at least once a year, present a report in the same way that we do for monetary policy on our consumer protection steps. Adopt a system of hearings or sufficiency reviews that would allow the public to see what steps the Fed was taking and provide input to make sure that actions were being adequately taken in addressing problems. And yet another possibility would be to upgrade and strengthen the Consumer Advisory Council, which was created by congressional action, to give it a higher, stronger status and ability to meet with the board on a regular basis. So I think there are steps that could strengthen the institutional framework that would address your legitimate concern about the long-term commitment of the Fed to this particular area.
Let me quickly jump lastly to this issue involving the power the Fed presently has of the bank holding companies. And again, all of us here, we go back to our respective states, and we get an earful on a daily, hourly basis about the unwillingness of these lending institutions to provide the necessary credit at a critical time when businesses are out there asking for it and demanding it, and there just seems to be no response at all. Now, we can jawbone on the issue, but the Fed has the power here to really exercise some greater influence. Why is that not happening? Why aren't we getting more support in order to demand that these institutions start being far more responsive to the demands of industry and business out there that are relying on these institutions to expand and grow and help recover?
Well, Mr. Chairman, I think the first order of business last fall was to avert essentially the collapse of the system, and that was a very important step. And we did achieve that, and the system now appears to be much more stable. It's still very challenged. Some banks are still short of capital. Other banks are concerned about future losses. They're concerned about the weakness in the economy and the weakness of potential borrowers. So there are legitimate concerns that banks have. That being said, the Fed and the other bank regulators have been very clear that banks should be making loans to creditworthy borrowers, that it's in their interest, the bank's interest, as well as in the interest of the economy, and we're working with banks to make sure they do that. I think that we are seeing improvement over time. We're seeing some stabilization in these terms and standards that banks are applying to borrowers. And I do suspect we will see some continued improvement, but we understand that issue, and we are trying as best we can to support bank lending through measures such as the TALF, which we already discussed.
Thank you. And I would hope, by the way, on the TALF decision, you might make that earlier rather than waiting until late fall on that. If you're going to extend the TALF, I think it would be helpful for the institutions to know whether or not that's going to happen earlier rather than later.